This is the Navigating Rising Interest Rates and Inflation webinar, which is part of CSI's Financial Literacy Month series of webinars. My name is Marshall Beyer, and I'm a Senior Director at the Canadian Securities Institute, and I will just take a moment to introduce this webinar and the speaker. First, I want to say that information contained herein are statements of opinion and not statements of fact or recommendations to purchase, sell, or hold any securities or to provide legal or tax advice. We ask that no one record this webinar without Moody's explicit written permission. Lastly, no one has permission to quote any of the comments made or questions asked by the webinar audience. Today's webinar is being recorded, and the recording will be made available on our website in coming days. All members of the audience are currently on mute. If you have a question, and we encourage you to ask your questions, please type it in the Q&A box at the bottom of your screen. Our speaker will answer the questions after the initial presentation, which will last around 30 to 40 minutes. We ask that you please keep your questions as generic as possible and avoid personal or client-specific information. When I started in the investment industry back in the early 1980s, inflation was in the double digits, and central banks around the world, led by the US Federal Reserve Board, were pushing rates higher and higher to slow the economy and break the back of inflation. It worked, although not without some pain and suffering, as the economy suffered 2 recessions in that short period of time. Once market participants gained confidence, though, that central banks were determined to slay inflation, equity and bond markets started to price in better times. The Dow broke over 1,000. Yes, the Dow struggled at getting over the level of 1,000 for many years up to 1982. But when it finally broke over 1,000, it didn't look back. And a decade of prosperity in the economy through the 1980s followed. Flash forward to the present, and we have a kind of similar situation now where the central banks, who arguably were a little behind the curve in terms of addressing inflationary pressures, are now scrambling to aggressively raise rates to establish or reestablish their inflation-fighting credentials. We are very fortunate to have Greg Zinitzky with us here today. Greg will provide us with some economic fundamentals related to growth and inflation and the monetary and fiscal tools authorities have to combat the recent inflationary surge. He will then take a practical look at how various types of asset classes and specific securities fare during inflationary times. Please keep in mind that this is not a forecast webinar, although Greg, I'm sure, will have some very good, strong opinions on where things are going. The goal here is really to provide you with valuable foundational information you can use to help yourself navigate the current investment landscape. Greg is a Vice President and Client Portfolio Manager at CIBC Asset Management, responsible for working with internal and external partners to develop effective investment solutions for clients, prospects, and consultants. Prior to joining CIBC Asset Management, Greg was a Client Portfolio Manager at Guardian Capital LP and at the Hansberger Global Investors, specializing in global quantitative strategies for clients in Canada and the United States. He holds a Bachelor of Arts degree in Science and Technology Studies from York University. He also holds the Chartered Investment Manager designation and is a Fellow of the Canadian Securities Institute and FCSI. So without further delay, I will hand the presentation over to Greg.
Well, thank you very much, Marshall. And we'll certainly be talking about those times of high inflation during the early 1980s when you started in the business. And so if we move forward a couple of slides, just to talk about, sort of set the framework here for what we want to chat about. On page 3, please. Thank you. So a couple of things, Marshall alluded to this already. What I thought would be very interesting is to combine the academic nature of our industry with some of the practical outcomes that we're seeing right now. There's no doubt on anybody's mind, investors' minds, advisors' minds, your minds, as to all the information that's coming out right now, whether it's got to do with economic growth, whether it's got to do with inflation, recession, interest rates, what kind of securities do well in these types of environments. So people are asking themselves that, and I think it's always important to combine that with the actual academic concepts. And I know that here we've got a number of people that are prospective students for the CSC or the IFC. There's current students in the IFC or the CSC. Some of you are recent grads. There's also members of the investing public here as well. So I think what I'll do at first is sort of paint a picture as to how we view the world from an academic perspective, and then apply some of that and show you what's happening in the real world. So when we think about economics, and many of you that have maybe taken courses or taken economics either in college or university or even in high school, there's always a difference between micro and macro. Well, I'm just going to talk about a few of the concepts in macroeconomics today. Microeconomics deals with some of the smaller things, and those are less important from a bigger picture investment perspective. We're going to be more concerned with things that are going on in the macroeconomy. So what's going on with GDP, what's going on with interest rates. Those are the types of things, inflation rates, for example, that are more compelling and have a direct impact on our investments. So if we drill down a little bit, move forward, and look at the concept of GDP. Can we put the whole slide up, please? So if we look at the concept of GDP, in terms of what it measures, basically it's the total output, the total market value that we produce in an economy. And we've got a couple of different approaches to GDP. And that's including the expenditure approach, which is the one I'm going to talk about in a little bit more detail. We've got the income approach, also the production approach there as well that we can talk about. And then we'll look at two other things. There's nominal GDP, which is the change of the dollar in the dollar value of goods and services right now. And then there's the real GDP, which is based only on productivity. And that's something that takes out the effect of inflation, because inflation is going to have an impact on that actual economic growth, because there's a difference. If we're just producing goods because prices are going up, then that's not really growth. If our GDP is going up. So we want to try to isolate the components from what is actually just price increases and what's actually productive economic growth in the economy. So on the next slide, I've got the GDP formula here. Now, this is not a webinar on anyhow the investment funds course or the Canadian securities course. So I'm not going to ask you to memorize this formula, but I think it's an important thing to talk about here. So the way we measure GDP or economic output is to combine consumption spending, business and investment spending, government spending, and then to net out the exports and imports that we use in Canada. And the reason I wanted to show the slide and why I think it's an important slide is because it talks about these components and what are the most important ones or the biggest ones. I shouldn't say important, maybe that's a little bit unfair. But the biggest one here is consumption, that's C. So that has historically been about 60% of economic growth in Canada. And so you can see that if the consumer is that important, you can see why we have to be cognizant of economic policies that impact the consumer. Inflation rates impact our spending. Interest rates impact our spending. Unemployment levels. All these types of measures will have a big impact on the C component of the GDP formula. And to be sustainable in terms of managing that economic growth, it has to be the consumer. Right? Businesses and government are about 20% each of that. And then the exports and imports, that's actually net a pretty small amount, although they are pretty big individual components. We do export a significant amount of products, but we import a lot as well. And most of that happens to go to the United States, which is our largest trading partner by far, and is also the world's largest economy. And hence you hear the term, when the United States sneezes, the rest of the world catches a cold. So, that is a very big trading partner for us. But those components of GDP are very important, and particularly for sustainability in the long term, the consumer or the consumption portion of that formula is most important. So if we move forward a little bit and look at the next slide here, we can see what's been the annual growth rate in our GDP, in real GDP. So this is taking out inflation. And you can see that it's certainly not, this is actually in real terms what's happened going back to the 60s. So we've had periods of much higher economic growth back in the 60s and 70s. We did have some issues in market corrections and crises in the 80s, in the early 90s. Maybe you remember even in the global financial crisis that occurred back in 2009 period when we had a big recession, a pullback. And then, of course, I think every single one of you can remember or at least appreciate what happened in 2020 when we had the COVID shutdown. We had a shutdown of economies around the world and a coordinated effort by governments around the world to shut down economies to prevent the spread of a disease around the globe. Now, keeping in mind these dates here that you see in the 80s, 90s, and then early just before 2010, if you look at the next page, you can see the actual performance of the market. And this is the S&P TSX Composite. And again, this is going back to around 1960. I've put in a few arrows there. And those arrows are indicative of those periods of negative economic growth, of negative GDP that we just saw. You can also see how the market has reacted during those time periods. So back in the early 90s, in the 80s, the 90s, in the period of the global financial crisis in 2009, you can see how the market reacts to that. So any sort of trends that are occurring or happening in the global economy are going to have impacts on investors and obviously have impacts on the market. So we need to be cognizant and certainly aware of what these different components of the economy are doing, because as you can see, they're actually going to have measurable impacts and have historically had impacts on the performance of equity markets, which a lot of your clients or maybe yourselves as market participants are already invested in. So on the next page, I wanted to show you some trends that we've seen. Now, I did show you sort of the jagged lines of the ups and downs in the actual economic growth and the GDP that we've seen over the last 60 years in Canada. But when we look at it from an academic perspective, we're looking at it overall in trends. And there's 5 specific periods that we follow through here. We start off with a trough, then we get to a recovery, we expand for a period of time, we reach a peak in the economic cycle, and once we've reached that peak, we start to contract during that cycle, and then we start back again to a trough, and we go again through a trough, recovery, expansion, peak, and a contraction through those 5 cycles. And so that's all these particular periods of the economic cycle that we see, or the business cycle that we see, they're all going to be characterized by different things that are happening in the market at any given point in time. And it's not necessarily cut and dry to say, okay, well, we're 100% in the peak right now, 100% in the contraction, or 100% in the trough. Sometimes there's gray areas. And as market participants, you're going to try to determine, where are we in this particular part of the economic cycle? And how do you insulate your portfolio? How do you invest your portfolio or prepare yourself, maybe that's a better way of putting it, for that upcoming next leg of the economic cycle? One thing that you'll notice here, though, is over time, from an actual dollar basis, we expect that GDP to grow. We want a rising trend in global gross domestic product. As GDP increases, a country's standard of living improves, everybody becomes wealthier, the whole country becomes better off for that. So that's the importance of GDP. If we look next to things like interest rates, so interest rates are going to have a significant impact on everything that affects the economy and that growth, right? So if we move to the next slide here, we take a look at interest rates. Well, interest rates are the price of credit, right? We feel that as consumers. It's the price of your mortgage. It's the price of your car payment. It's the price of your line of credit. That's how much money you have to borrow or how much you can borrow is really going to depend on the price of credit. When interest rates are very low and credit and money is basically free, it's very easy to borrow and think, okay, I can pay that over the next 5 years. But as rates start to move up, consumers, just like businesses, and I'll start with consumers, we're going to start second thinking our decisions. If you're buying a car, 3 years ago and you could get 0% interest or 0.9% financing, okay, that's a very small amount to pay for that brand new car. But if you're going to go and buy a car and that interest rate is all of a sudden 7.9%, that adds a substantial payment to your monthly payment, or a substantial amount, pardon me, to your monthly payment. But then also over that period of time, it's a big cost. So you might rethink that, and maybe you can get 2 more years out of your existing car and then save a little bit more so you can keep your payments down. So that's going to impact all of us, particularly the big ticket items, houses, cars, appliances, renovations, things that people often borrow for. And then businesses are exactly the same way. The credit will impact businesses that way too. Businesses borrow money to continue to expand, to grow, to take on new projects. Businesses want to borrow money to be able to make money off that and use the effects of leverage. If a business can earn 10% on a project and they can borrow money at 2%, then they've got a lot of leverage. They should be doing that all the time. But if they're borrowing at 8% and earning 10%, there's a very small margin of error. Any sort of hiccup in that business plan can lead to negative returns. So there'll be more cognizant of that borrowing. And so the bottom line here is that we feel these changes throughout the whole economy. Everybody in the economy, whether it's a business or a consumer, was going to feel the impacts of those rates. And if we move on to some of the factors here, then we think about what drives interest rates also in terms of your actual rate that you'll pay. Well, one is the demand and supply of capital. And we'll talk a little bit about how the Bank of Canada can increase the money supply or decrease the money supply, which can also drive interest rates up or down. Default risk. Well, just the same as, you know, any one of us has a credit score. When you go to a bank to get a mortgage or a loan, you'll have a credit score. Businesses also face default risk. Businesses have credit ratings on their bonds, and Moody's will publish credit ratings on all sorts of companies as to what is the credit risk associated with specific companies' bonds. Foreign interest rates and the exchange rate are another issue that needs to be considered. Money tends to flow to areas that have higher interest rates. So we do, you do want to maintain that sort of parity or something relatively similar if you want to sort of avoid the outflow of capital. The credibility of a central bank, now that's very important, I think, because, you know, how do they enforce those interest rates? I'm going to talk about that when I get to the portion about the Bank of Canada and what they do in terms of some of their open market operations. I think that to show you how it maintains credibility, so that when the Bank of Canada raises rates or hikes rates or lowers rates, that rate will be will certainly be imposed, really, if you will, or respected by the market participants. And finally, inflation. Inflation is really going to be a big driver of rates, because the cure for inflation is interest rates. So as we see inflation moving up, we're going to see interest rates start moving up, really to try to curb that inflationary spend. So if we can increase interest rates, we can drop inflation, or hopefully, slow down inflation so that people stop spending as much. So on the next slide, I'll just spend 2 seconds. This is probably more relevant, would have been more relevant a couple of years ago. On the next page here is negative interest rates. We've sort of definitely moved off the bottom now globally around the world. We did hear about negative rates in the US in March of 2020 during the COVID shutdown. We heard about that in Europe. Did not hear about that in Canada. So, we are now moving up in terms of the rate cycle. So who knows, at some point in time, if interest rates move up and they start coming down, we can talk about this again. But I think at this point in time, negative interest rates are sort of just old history. So if we think about, on the next slide here, about CPI and move over to that inflationary framework. On the next slide, please, in terms of how we measure CPI. So we measure CPI using a formula. Again, I'm not going to ask you to memorize this formula here. If we can just put that up, please. But we're looking at what is the current period of CPI versus the previous period in terms of what is the percentage increase. And CPI is really just a basket of goods. It's called the Consumer Price Index. And how much is this basket of goods as representative of a typical family spending? How much is that going up or down in any period? So that's how we measure our inflation. And to show you on the next slide here, where it's been historically over time, you can definitely see there's been periods of very high inflation. Now, if we're talking about the periods that Marshall was mentioning, starting in the industry back in the 80s, you can see where inflation was. Hit about 12%, over 12% back in the early 1980s, before coming down, still high in the 5-6 range, and then coming down from about 1990 up until about 2020. We've had 30 years of relatively stable inflation. I'll address the little blips towards the bottom there in a minute. But we've had relatively stable inflation. And what the Bank of Canada is trying to do, the policy is to try to keep inflation stable. And I'll show you in a minute, how equities, how different asset classes perform in a stable inflationary environment, and why, we would want to try to maintain that as a central bank, or why policymakers would really like to keep that type of inflationary target. So on the next page, you can see we've had some periods where inflation has been negative, and we call that deflation. So it happened there in the global financial crisis in 2008, 2009 period. It also happened during 2020 in that period. Those are usually short-lived periods. The financial crisis was certainly an issue where you had leverage and a lot of debt spending. But in 2020, we also had the economic shutdown. So moving on from CPI, let's move on to fiscal policy and look at what governments tend to do. So the government has the ability to lower or increase individual and business taxes, right? As it increases taxes, it makes it more difficult to spend. It makes people want to save more. And at that point, you're going to start lowering inflation. So it's going to have the similar effects that the monetary policy is going to have. But the more a government spends and the lower charges and taxes, the more stimulative it'll be for the economy. The more it taxes and the less that government spends, the more it's going to try to slow down economic growth and slow down inflation. And if we look at the Bank of Canada on the next page, we can see that they've got 4 areas of responsibility here. The first one is the most important one, and that's actually going to be monetary policy. So that's the one that we're looking at, and that's the one we're going to talk about. That's the most important. The other 3 that they have is to make sure there's an efficient financial system. So they're the clearer of the financial systems that make sure that everything is going into the right place. They do actually make the physical dollars, physical bills and currency that we use. But again, less of an impact for us in terms of investment landscape. And then also managing some of the government's assets. Now, I have a page here on the next slide here showing you just a carve out of the Bank of Canada website. And I will say this one thing. Now, just to say this, I don't work for the Bank of Canada. I have no ties to anybody who designed the website. But I do think that the Bank of Canada has a very good website. It's a very user-friendly website. And if you have a chance, you should use it. I've used it personally, professionally. Very easy way to access information on that website, very user-friendly. Everything that you need to know about economic indicators, timely and updated, and you can pull all the historical information out. So as we drill down on the next slide here, what I did want to point out is the policy interest rate. So you can see that interest rates, now if we went back to the beginning of the year, we were at 25 basis points. So we've seen a big rise in interest rates. We went up to 3.75% from the beginning of the year. So those have moved up to this year. And most recently, we had a rate hike in Canada as well of 50 basis points last week. And this week, actually later on today, we are going to be expecting a rate policy announcement from the Federal Open Market Committee, which is the U.S. Federal Reserve. I'm talking about U.S. interest rates, and they're going to give their indication of interest rates going forward and talk about their outlook for what's going to happen. This is also information here that we have from the government, from the Bank of Canada website, and I think it's this is just snapshots of some stuff, but you can definitely see the policy adjustments that we've seen over time. You can see the schedule. You can see the schedule for 2023, but here we know that on December 7th, we have one more announcement coming from the Bank of Canada to tell us where they're going to be taking interest rates. So if we move forward to drill down a little bit more on monetary policy, we look at a couple of different things. So open market operations. Now, I mentioned earlier on that one of the determinants of those interest rates is going to be the credibility of the central bank. Well, one of the things that the Bank of Canada does is enforces its policy interest rate. And they use a couple of things. Those of you who have taken the securities course or have taken the investment funds course are familiar with SPRAs, special purchase and resale agreements, and SRAs, which are sale and repurchase agreements, which is how the Bank of Canada ensures that its target for the overnight rate is enforced. And this helps to add credibility to that central bank because participants in the market, whoever it may be, down to us as consumers, larger players, institutions, banks, insurance companies, lenders have confidence that when the Bank of Canada says our target for the rate is 3.75%, the Bank of Canada is going to use tools to ensure that. The next thing they can do is drawdowns and redeposits. So what they can do here, if we move forward, is they can actually deposit money to the banks, and they can draw down their deposits at the banks. So whenever they take down their deposits from the banks, they will limit the amount of cash that's available in the banking system. And when they redeposit, they're actually increasing the supply of cash that's available. Now, when there's more cash available, you're not competing with as many people. But if there's less cash available, if they draw down those balances, then borrowers, are competing with each other for a limited amount of capital. And that can in turn drive interest rates higher, which can in turn curb spending, which can in turn ultimately slow down economic policy. So I want to turn a little bit now sort of to a more of the practical application. What does all this mean? I mean, I want to recap that in a second, but if we go forward now to look at the different types of asset class returns, before we do that, I should look at some of the challenges of policy. I apologize. There's a few things about the government policy just before we get into the actual practical application. Things happen, and although it sounds great that the government can increase taxes, the government can spend more money, the government or the Bank of Canada can increase rates, or the Bank of Canada can draw down their accounts. All these types of things can impact the policy, but they take time. So these are not things that impact anybody overnight. So there is time lag. So any government policy to be felt through the system will take a little bit of time. Politics play another big issue, right? So politics are going to happen from a number of things. One, there's going to be legislative calendars that they meet on, and then when they have certain items for discussion. There's also issues with re-election. People might want to get reelected and say something, and then, once they get there, realize that it's not really possible to do that. In terms of expectations, we might have different expectations for what the government has done versus what the government would want us to expect that to be. Coordination of government policies is another issue. The federal government wants to say, if the federal government wants to cut taxes, well, that might be offset by a provincial tax increase and even a municipal property tax increase, thus muting the effect. So if we want to stimulate the economy at the federal level through cutting taxes, we might see something offsetting that on the provincial and municipal level. High debt for governments, just like for us, the higher the debt, the more difficult it's going to be to do stuff. Personally, we can be impacted by high debt. So can the government in terms of their ability, their flexibility to take on more debt to stimulate an economy. And then, of course, the impact of international economies. And this takes me right back to what's happening in the US can certainly have a very big impact to us, particularly because it's our largest trading partner and the largest economy in the world. So we have to be cognizant of what's happening in other parts of the world. So now if we move forward to the next slide to some of the more practical application of all this, and we've talked about everything and why we're concerned about it. So let's take a look at a various different asset class returns, anything from equities to fixed income, REITs, and other types of specific equity components. And one thing is in the middle. So you notice that stable inflationary period. And I talked about that earlier on in our academic discussion, showing these periods of inflation that we saw relatively stable, going back from sort of the late 80s, 1990 till 2021. So we had a good 30-year run of stable inflation. And we want to accomplish stable inflation because we've got those types of asset class returns. Those are very sort of average returns, good returns that we've got over time without any outliers either on the positive or negative side. When inflation starts coming down, equities tend to do better, commodities tend to do poorly. And if you see to the far right, when we move to rising inflationary periods, well, then we've got bonds, equities, real estate, all doing poorly, and certain elements of equities, or I would say probably commodities, so whether it's commodities, precious metals, mining equities, energy equities, tend to do better during those periods of inflationary time. And we'll talk about those in a minute. But first, if we go forward a slide and look at fixed income. So why in inflation expectations, why if inflation is going high, running high, why does fixed income not necessarily do as well? Well, because rising inflation is going to trigger some tighter monetary policy. Tighter monetary policy means increasing rates, which is something that we're going through right now. We've seen increasing interest rates, that drives tighter market credit conditions, and that leads to higher discount rates for all types of bonds. And ultimately, when we see higher discount rates, so we have higher interest rates in bonds, we're going to see lower bond prices during this period of time. So this is something that's going to be an impact from this. So the cure for high inflation, which we're using as interest rates, is going to have a negative impact on fixed income securities. And you can see what's happened on the next slide here over, going back. This is going back over 107 years here, over different crises. I mean, we don't have to talk about all of them, but you can see how the interest rates during big deflationary events, going back to the Wall Street crash in the 1920s. We saw the LATAM debt issue back in the 80s, the tech bubble back in 2000, what we saw during the subprime crisis in 2007 to 2009 period, what we saw in the COVID-19 period, all these deflationary events, you can see how that rate after that period of time, that blue line kept going down. So central banks were dropping interest rates, or in this case, this is the US Fed, dropping interest rates to protect investors or to stimulate economic growth. If we move forward, we'll look at a couple of things that we can do, and I'll talk about just a few different bond issues. So one thing that you can do during these periods is to reduce the average term to maturity or the duration. And the duration is just the weighted average sort of time of all the cash flows that bond is going to pay. And one of the things about that during rising interest rates, it's fairly easy to do. You can do it pretty quickly. You can customize it to your client portfolio, to your own portfolio. And if you're using Government of Canada bonds or US Treasuries, for example, it's going to be very low cost because the spreads are going to be very small. If we move to the next page, we can talk about things like inflation-linked bonds. And this is going to apply, my next slide after to talk about Canadian, but we'll talk about US first. So Treasury inflation-protected securities, which we call TIPS, they're issued and guaranteed by the US federal government. And just like in Canada, they've got 5, 10, and 30-year maturities. They pay semi-annual interest. But the good thing here is that they are adjusted to rises in CPI, with the Consumer Price Index. So you are not going to see that same erosion of your capital, of your principal. You're not going to have to sell that bond at a discount because they're going to adjust the interest rates up for you as interest rates move up. And the same on the next page where we've got real return bonds, which is the Canadian version here. These are, again, issued by the Canadian government and guaranteed by them. Same maturities, 5, 10, and 30 years, semi-annual interest. And again, same types of pros here that you have, because they're not going to have that discount when interest rates go up. So they're going to ultimately be less volatile than fixed-term Government of Canada bonds. So you're going to see an improvement, or if you want to protect against inflation, one way to do that is either through TIPS in the US or through RRBs in Canada. One other way to do that is to do it through floating rate notes. And so these are floating rate notes, which we sometimes on the next slide, which we also call floaters. These are issued by corporations, by banks. Can we move forward one slide, please? So they're issued by corporations or by banks, governments, and they have a variable coupon rate. So it's usually tied to some sort of a benchmark rate. And those maturities can be 2 to 5 years, can be up to 20 years. It's also going to be here, because we're also talking about corporates, it could be the credit rating of the issuer, the term to maturity. Those are all going to have certain impacts, but you know that those rates are going to move up with inflation. And finally, on the next slide, we've got inverse bond ETFs, and these are called bear bond ETFs as well. And what they do is they move opposite of what bond market prices do. So, you might not be exposed to this all the time. You might buy this at certain points in time. You might close these positions at certain points in time. But what you're trying to do is buy a security that's going to rise in an inflationary environment as interest rates increase and bond markets fall. So you're buying sort of the other option, the other side of that particular market. Now, you probably don't always want to be a bear bond or always buying those, but you can make your own decision as to whether you're concerned about inflation and the impacts, and that's one way to get some inverse exposure to the market. So if we move forward now to talk about commodities, you can see that there's a big correlation with inflation, particularly with things like energy. And you can see energy, copper, other broad commodities, some other industrial metals, agriculture, precious metals, gold. You can even put the equity market there. How they correlate with inflation. So as inflation moves up, if you remember that chart I showed you about 7 minutes ago, the ones that do well, we're on the right, and there all types of things that do well, energy, materials. Now, if we look back to the next page here, we'll look forward to the next page, we can see how commodities have done this year. And, here we've got data going back 107 years, back to 1915. So back to the times of the First World War. all these different types of periods that we've had, the oil shocks that we've had over time, this is the strongest start that commodity prices had since 1915. So a very, very strong start to the year for commodities. We started seeing that inflation move up, so it's not very surprising that we did see that. Now, on the next slide, not only do we have commodities move up, but they've also been cheap relative to equities. And the argument can be made that they were ignored since the global financial crisis. We moved into a lot of different things. If you remember during the global financial crisis, you remember how high oil got. You remember at that point in time, maybe some of you remember, but the Canadian dollar was trading above the US dollar because of the strong oil prices. And then after the recession, things collapsed. And then the energy prices sort of went down and have been cheap relative to equities for a long period of time. So how do you gain exposure to this? If we look at on the next page here, and how do you gain exposure to these? Well, one, you can do it through a direct physical investment. That's probably only applicable if you're going to buy gold or silver bars, if you wanted to. Much easier and much more practical in some cases to do it through derivatives like futures. None of us probably have room at their houses to stock barrels of oil. So we're physically not going to buy those investments in things like oil. Or so you can do it through derivatives, or we can do it through equities that are linked to commodities, and either ETFs that are linked to commodities. So it could be an energy ETF that might have exposure to oil, gas, uranium, other things. It could be just an oil ETF. It could be just a uranium ETF, just coal, for example. You can buy commodity sector funds. So there's mutual funds and ETFs that are geared into one specific type of commodity or a sector. Or there's also individual commodity related equities that are geared into that exposure. So two things on the next slide here to think about in terms of the performance of equities in an inflationary environment. One is, are they able to pass these rising costs through to consumers? Because companies are going to have input costs or cost push inflation. Can they push that through ultimately to the end user is going to be a big driver of how that one is going to do, how that particular equity is going to do in an inflationary environment. And then also, where is the revenue growth coming from? Okay, so that's another important part. So where are you driving this revenue growth in your business? And how geared in are you to multiple compression? That just means in terms of falling equity prices. So if the overall stock market is falling, then maybe you're geared into that. There's going to be a component of that. But perhaps if you are in a stock or a company or a sector that is a little more insulated from the impacts of that, you may perform better in an inflationary environment. The other thing on the next page is sector selection. And this is very important. So when I showed that slide a few minutes ago, talked about which parts of the market are better in higher inflationary environments. We talked about the materials and energy areas. So sector selection is going to be very important. If you're looking at individual securities, looking at specific sectors, you will have better experiences, or historically, we've seen different areas of the market do better than others. And on the next page, we've plotted for you a number of different sectors here. And you think about the 11 gig sectors here. And on the y-axis, we've got the high level of outperformance versus inflation and the probability of beating inflation on the x-axis. So no surprise, precious metals, base metals, energy tend to do better during these periods. Consumer staples, financials, and healthcare tend to do okay as well. Financials, tend to increase their net interest margins, although the offset is lower loan and mortgage initiation. Consumer staples, again, you are able to pass through that more. If you think about a staple, if you're going to be buying milk, whether it's $5.99 or $6.99, you've got children at home or you want milk, you're going to buy that milk even, so that cost can be pushed on. Whereas something like consumer discretionary, you think about the bottom, well, you might think twice about that item. Discretionary items. Do you need to buy a new suit or a new shirt on any given day? Well, if those prices are going up, I probably don't need to buy a new suit right now, but I still need to buy milk and bread and those kind of staples. So the ability to pass through is one. The other things, some of the other ones, for example, things like information technology. If you think about that, that's IT down there. In an environment of IT is a very high growth type space. When you're buying IT companies, you're usually buying future growth. So you're thinking, what is that going to do for us in the future? So you have to discount those cash flows. So companies like technology, as interest rates go up, you're going to see you're going to see some pullback in terms of their actual valuation, only because of this rising interest rates, which are creating an increased discount rate, which is going to value those future cash flows less and less. So when we see higher inflation, it's not higher inflation really that's impacting IT. Higher inflation is the disease, and the cure is higher interest rates. So the higher interest rates are going to impact areas of the market with long-dated cash flows like information technology. So the last couple of slides, if we move forward to the next one here, commodities, tend to be the top performers, as we said here. I've been talking about this in inflationary environments. And if we move to page 40, the next one, pardon me, just want to show you the difference between Canada and the US in terms of how much exposure there is in the markets. So for the S&P 500, the US market, I've broken it all down here for you in terms of the different areas. You can see information technology is big, but only 7% of the weighting in the S&P 500 in the US benchmark index is materials and energy. And if you compare that on the next slide to what we have in Canada, you can see in Canada, energy and materials combined are almost 25%. They're 24.6% of the market compared to the S&P 500. Now, if you add financials in that, so in Canada, a very big part is financials, energy, materials. You've got about 55, almost 60% of the market is in those areas. Compare that to the S&P 500 in the US, which is about a third of that. So very different types of exposure in Canada. And that's sort of reflected on the next page in terms of underperformance relative to each other. When we had the commodity boom, you can think about some markets, you can see the Canadian markets on a relative basis, or the S&P 500 relatively underperforming the US, but sort of since that period in the global financial crisis where we saw a big technology boom in the US, and that's why I thought it was important to bring up that component there about different exposure across sectors. That's why the US has outperformed Canada for the better part of a decade there, because they have much more exposure in these technology type companies. And so finally, the last slide here to talk about sort of the way to get exposure in some of these products is either through specialty equity mutual funds. This can improve your inflation efficiency in your portfolio or a client's portfolio. Of course, it's always important to remember that there are a lot of risks with any of these types of companies as well, or with any of these types of exposures, and all of this should be in a measured format applicable to either your risks or to client risks. So, Marshall, with that, I think I'm going to stop it here. I know maybe I went a couple minutes over time here, but happy to open it up to some questions that we might have on any of the subtopics we covered today.
Okay, and I'll remind the audience to submit your questions through the Q&A icon at the bottom of your screen, and I'll relay them to Greg. But Greg, maybe to start things off, certainly the inflation fighting credibility of the central banks is really important in sort of winning back the market's confidence that the central banks are serious about getting inflation down, and that'll sort of lead to better times in the future. So even before we start to see maybe the CPI index start to ease and pointing towards lower inflation, are there any other indicators that you might look for that'll give you a sense that we've made the turn? Maybe the yield curve. Maybe you might want to comment on the yield curve as a sort of one indication of the market's confidence or lack of confidence in the central bank's ability to fight inflation.
Sure. Yeah. The yield curve has always been a predictor. It's been, but I think as the old saying goes, I think the yield curve predicted 11 of the last 9 recessions. Right. So, but that's certainly a big indicator. I think a lot of market participants, I would agree with you 100%, do watch the yield curve and what that's pricing in. But I think also watching for some surprises from the Bank of Canada. I think, we had a pretty big hike of 1%, and then we were surprised by the 50 basis point hike. I think the market was expecting a little bit more, and the Bank of Canada dropped it down to 50 basis points. I think it's certainly going to be very interesting to see what happens on December 7th. As I think there's some general consensus that there's going to be one more rate hike now in December, and then a bit of a pause to see what happens. And I think there is a little bit of a lull that the yield curve will be pricing in for a period of time. Now, I think it would be probably odd to see them all set hike and then just start dropping immediately right after that. So I think there's going to be a measured response from the Bank of Canada, again, because this will take a little bit of time to move through. There are other indicators that you could watch as well to sort of predict, where that's going. Yield curve being one of them, but other economic indicators, home starts, home sales, for example, new building permits, for example. These are leading indicators that give us sort of the general consensus of how confident are people that that market will be there. So when you see those types of leading indicators start to forecast, either an upturn in growth or maybe, pause in that interest rate cycle, then we'll build a little bit more credibility in that space as well.
Okay, great. So we have a bunch of questions now. First, I am wondering how cryptocurrency and blockchain tech fits into this environment today, in your opinion. It's, I guess there was one school of thought that said that during an inflationary time, those types of assets would become more valuable, as gold would, but neither asset class has really performed that well in this inflationary surge that we've seen the last number of months.
Yeah, so I mean that's for me personally, things like crypto it's still relatively new. I think it's a bit more of a speculation. I mean, it's been added. A lot of people have added that to their portfolios. So I know that people are looking at it from a portfolio perspective. I personally don't have any opinion specifically on crypto at this point in time in terms of that technology and how it's going to play out ultimately. There is talks about central bank digital currencies. I don't know if that's going to replace it or not, but I think that is an unfolding area that probably has a place in client portfolios at some allocation, but it's really going to be, again, something that's going to be measured depending on every individual person.
Okay. Thank you, Greg. I think partly answered this already, but how has, if you look at the Fed and all the central banks around the world, their actions in raising rates over the last number of months, are we starting to see some benefit? Is it actually working, or is monetary policy really a policy tool that takes time to really have an impact on inflation?
No, I think we're starting to see it starting to work. There are definitely some areas of the market that we're starting to see some of that. But again, I think the time is important, but we are definitely starting to see some improvements there from that. And I think that's why we probably saw the tone from the central bank, even Bank of Canada, surprised with a little lower of a hike and a little more dovish. I wouldn't say dovish in terms of their total tone, but a little less hawkish in terms of their tone for future rate hikes. So, and they also want to take that measured wait and see approach, because it's a balancing act, right, Marshall? It's very difficult, to try to balance this whole economy. We as market participants, investors, advisors, we can all comment and say what we'd like to see and how it all happens and play out. But in the real world, if things happen too fast, you can easily get into a deflationary period. You could end up with a hard landing. Navigating, it's a very big ship to steer. So I think we started seeing at the margin, but we need to be very cognizant of how we continue to navigate that and to ultimately to get a soft landing that will be in the best interest of all Canadians.
Right. Well, we certainly saw some missteps perhaps in the UK, and we saw what the aftermath of that was. So it's a very delicate balance for sure. Here's another question. During a high inflation, isn't it advisable to invest in REITs, given that they're at such discounted prices now?
So investing in REITs. So there's first of all, there's a couple of different types of REITs, whether, depending on what they are, whether they're industrial, whether they're residential, whether they're commercial, mixed use REITs. So there's a number of different REITs that you're going to want to consider in terms of what you want to invest in. Now, the timing of your investment is probably going to be the ultimate determinant. So REITs, for example, or equities and fixed income tend to underperform during inflationary periods, but that does reverse, right? So ultimately, you will see equities, REITs, fixed income do better. So it's a matter of timing that decision. And I'll say, just to answer your question, that it's a matter of timing that decision. Now, my personal view, or my opinion would be for an investor in a diversified portfolio investing for the long term is to stay invested and not necessarily try to time the market. REITs provide you a good exposure to the real estate market, gives you direct exposure to stuff that you don't normally have. Most of us as investors, we don't have ability to buy commercial properties, shopping malls, apartment buildings. You have no way to access that. It's a great diversifying component for any investment. So adding that kind of exposure is good. But I would argue that it's more time in the market as opposed to timing the market. So whether you're getting into REITs now or whether you got into REITs 3 years ago or whether you're going to buy into REITs 2 years, I think, looking at it from a long-term perspective, it's going to add a diversifier that's going to give you access to things that you otherwise don't have access to.
Right. Good. Thanks, Greg. Here's another question from the audience. Are interest rates and taxes, i.e. monetary and fiscal policy, the only ways to combat inflation? Or are they just the current methods of choice?
Those are the two main ones. So fiscal policy and taxes. So it's taxes, but it's also government spending. So it's taxes and spending, and that's done through the fiscal budget or the annual budget that the government has. So I would add to taxes, government spending is another one. If they curb spending, that will help decrease inflation. Because remember, the government can add as that particular component can be sort of a check on the economy. They should increase spending and they should decrease spending they should increase spending, and decrease taxes when they want to stimulate the economy. But at this point in time, they should be if they want to slow the economy down, they want to increase taxes and cut down spending, right? Hopefully they'll have if they have a surplus, they can cut down that spending and start paying off that debt. On the monetary policy side, yes, the big one is interest rates. That's the most visible one, but it's also controlling the money supply. That's the other component, right? So money supply is important too, in terms of drawdowns and redeposits. If the Bank of Canada takes money out from the big banks that they have accounts with, they are taking money out of the system. So that's also going to have a cooling impact on inflation, because now instead of 50 of us competing for $1 million, now there's 50 of us competing for $800,000. So rates are going to go up, so there's less of that ability to borrow, less spending. So I think the central bank's ability, to control that money supply is another way to do that, which is coupled in with interest rate policy as well. And remember, it's two different parts. So the central bank operates independent of the government, and it controls interest rates and money supply. And fiscal policy, which is government spending and taxation, is controlled by the government. So two separate arms working to try to achieve the same goal.
Right. Good, thank you. And I suppose, one of the benefits of globalization over the last 30 years has really been, I think, to keep us in this kind of low inflation environment. But globalization seems to be threatened right now. And I wonder if that's playing into the inflation equation as well in a negative way.
So there has been, obviously an impact to that. I think I would agree with that. We've gotten a lot more intertwined with our economies, and I think it's probably debatable as to what the causes are, and we could probably have a discussion on this, for hours on end. But if you think back to the economic shutdown we saw in 2020, this was a coordinated global economic shutdown. This was pretty much every big government, every big economy in the world was shutting down at that point in time. It was not predicted. It was an external shock. It wasn't because of leverage. It wasn't because of valuations or anything like that. It was to control the spread of a disease around the world. So we had to do something to keep people safe. So everything was shut down. That ultimately, the restart of that economy led to a number of different issues. There was shortages of a number of things. We saw supply chain issues, constraints. I think everybody felt it. You think about the semiconductor industry. In Canada, we're not doing that. We buy all our semiconductors in Asia. So, that's for even Canadian manufacturing a car in Canada. You need semiconductors, you need components. And so how these particular companies then reacted to this when they had to shut down and prioritize who their biggest customers were, and so we felt issues and backlogs throughout all of that. In some places there were labor shortages. So we've seen that sort of start playing its way through. And ultimately the other thing that we saw was a lot of free money, really, if you will, right? We saw very low interest rate policies. I mean, we went down to 25 basis points and we saw zero interest rate policy everywhere. So there was the ability to stimulate the economy, which had to be done because we went through this massive shutdown where spending went to zero. So we did see a lot of money out there, a lot of our spending. So there's a number of things that I think are driving that, and partially being a global impact, Marshall, I think that's right, and it makes sense. That it has to do with this globalization, but we're all on the same page around the world in terms of controlling inflation. I think there's no parts of the world where inflation is not an issue, where everybody's not concerned about inflation. We're continuing to see that and seeing coordinated efforts now to combat that and smoothen out the implications of that period.
Great, thank you. We've got lots of questions here and only a few more minutes, but I'll try and at the questions that are most often asked. There's been a few on gold. We alluded to it earlier, but the questions relate to why hasn't gold responded as it has in previous cycles to this inflationary phase that we're going through.
Yeah, that's so gold has always been a store of value and tends to do better in inflation. Gold might just be late coming to the cycle. I mean, it could potentially be other people looking to other sort of stores. People have even talked about cryptocurrencies in this type of cycle, moving that as to that store of value. I think we've seen, generally speaking, we have seen commodities and energy as a whole tend to do better. Gold did have a decent run, for a period of time, but really, I don't know if it's going to have a run during this inflationary period. If this continues, you would have typically expected it to happen, but it didn't occur this time around. So maybe it's going to be late to the party.
Maybe, yeah. We have a question here. I guess we've been obviously talking about asset classes and specific securities that have performed well in inflationary times. But what if the central banks are successful and the markets believe they're going to be successful in ushering in a lower inflation, lower interest rate environment? What sort of investments might perform kind of the best in the early stages of a new kind of economic cycle? Even if we enter into a recession, we know more stock markets start to bottom out well before the recession ends. What sort of assets or specific securities perform well in that environment?
Well, typically equities do well in that environment. Equities will start to do better in that environment. You'll also see fixed income, REITs all start to do better in that environment as well. You'll generally see those traditional asset classes do better. What you will see underperform then, though, is things like commodities. Now, in equities, commodity-related or energy-related equities might underperform during that period of time. In general, I mean, there's differences between energy equities in every part of the world, but generally those areas, you'll see things like technology, healthcare. Those areas of the market tend to do better because once we get that stable inflation, once we start seeing those interest rates start coming down, then we start seeing the discount rates come down. So the long-term value of those cash flows, because if you think about it, you're not buying a stock for what it did last year. You're buying a stock for what it's going to do in the next year, 3, 5 years, what your expectations are for that. So you're thinking, because what happened last year is already there, it's done. That's you can't make money in that now, but you can make money in terms of companies' prospects in the next 3 years. So you're going to discount those cash flows. And if you think of a tech company, you'll say, okay, well, they're going to earn this much money. What is that worth in today's dollars? The higher the interest rate, the more negative it's going to be. If inflation stabilizes, if the central banks are successful in doing that, and interest rates start to stabilize, and if interest rates ever start to come down, then you will see a big improvement in some of these longer duration assets, and that would be, in equities would be longer duration. I just mean companies that have long dated cash flows, things like technology, for example, where you're expecting that technology to have a payback period in a longer period of time, but you're also expecting a more significant payback over that period of time.
Great. Okay, I think we'll take one more. And this is a good question. I know there's been some discussion around it, but given that much of the inflation we've seen has come from, maybe the Russia-Ukraine war, supply shocks, etc. Is an approach of interest rate hikes aimed at decreasing, consumer demand, business expenditures, etc. Is that the correct approach, or is this combating an area of inflation that is not really the root of the problem? And you hear that sort of talk now and again. Are we using the wrong medicine for what's ailing the economy right now?
Yeah. So, well, yeah, I can see that argument. One of the components of too is, if you think about inflation, energy is a big part of it, and so the Russia-Ukraine situation causing an increase in energy prices felt very, very, very much so in Europe. Increase in food prices and grain prices in parts of the world. I think even places like Turkey, for example, I think 100% of their grain comes from that Russia-Ukraine region. So they've got to find places to source all this sort of stuff. So it's having a lot of those types of issues, absolutely. But also energy is a big part of the production of any sort of items too. So, interest rates are going to ultimately curb spending. If we curb spending by consumers, around the world, we'll start to drop down those prices. We'll start to drop the demand, which is also going to decrease that demand for energy. So, yeah, that is a very, very valid point to think about that situation. But I don't know that policymakers have come up with a neat way of isolating just that particular component and treating just that one. We're sort of taking an approach to try to cure this inflationary issue, and the best way that they know how is through interest rates and central bank policies.
That's great. Well, thank you very much, Greg. It was an excellent presentation and conversation today, and this concludes our event. If anyone in the audience has any additional questions, please email us at designations@csi.ca. Once again, a replay of this event will be available on our website, on the CSI website, in the coming days. And also, for more information on upcoming webinars, please visit our website at csi.ca. So thank you, everyone, for attending, and have a great day.